Hello traders, this is Nimbus Capital here. So this session, I'm gonna just do some ad hoc ranting just to explain to you why most traders out there, they cannot be profitable. No matter how hard they try, they just seems to not be profitable despite going for so many courses here and there, right? Typically, it has to do with how trader handles retracement period, because last Friday we have a short retracement on the Dow Jones or the overall market itself, and it seems like everyone is panicking. It's like in my Facebook group, in my Telegram channel, I keep seeing things like, oh, the good times are over, market is crashing, Omicron this, Omicron that, there's blood on the street, there's carnage in the market, all these kind of over exaggerated words. And these kind of words they do impact you mentally on how you look at things, and then you start to do funny things, like you prematurely exit your position, you start to abandon all your trade plan, and you start doing all these funny things. So on my screen here, right, you see this uptrend right here. So imagine that this uptrend is the market movement. And imagine a typical trader. During the first leg of the uptrend, this portion you see here, okay? Imagine you are a trader trading during that bullish period of the market. In that bullish period, the thing is, no matter what strategy you use, no matter which guru you follow, no matter what kind of, even if you blindly buy something, right, most likely you are going to be able to profit because the market is going up like almost 90% of the time if you are trying to buy together with the market. And the key thing here is that for most of the trader, right, even though the market went up by this much, most of the trader, they will not be able to maximize 100% of their profit. So what I mean is, even though the market go up by this much, what a typical trader might get is probably only like this. Let me use a different color. Okay, so probably they will only get something like this. Okay, so even though the market went up like this much, most trader will only get this much, and it is usually quite true for a lot of traders who are using CFD, big leverage, and then the account not so much. So whenever they see a little bit of profit, right, they start to run already. They don't have the discipline. They just want to immediately see, like take that profit. They can't even handle like one or two red candles. So for example, in a case like Nvidia, the entry signal came out here. Okay, so those are the kind of people that they follow my entry, they enter here, and then when markets go up here, they very happy, they super happy, they see profit in their portfolio. But the moment retrace, right, they panic and they run with their profit already. So instead of getting the whole uptrend, right, they only get like maybe like this much. So I am referring to these kind of people, those who cannot retain their profit, those who cannot keep to the trade plan, just a bit of green they want to run. And sometimes they will tend to console themselves, got money can ready lah, cannot be greedy lah, this and that. And these are the excuses that I hate the most, because if you cannot maximize your profit during the bull phase, right, then how are you going to handle when the market become bearish? Because you cannot avoid a bearish market. You cannot avoid hitting stop loss. At some point, you are going to hit with stop loss. And if you cannot maximize the profit that is available to you in the bullish period, you are not going to be profitable. So let's continue with the illustration that I'm trying to show. So suppose you are that guy that, wow, don't want to be greedy lah, become very high morale, or the like we must be content, this kind of like very inspirational quote. Trading is trading. Live your could leave your high moral value out of trading. You want to do those, okay, fine, but trading is trading, okay? So let's say during this bullish period, you are only able to get this amount of profit, and you are pretty happy. You are happy with yourself. You might be even thinking to yourself that, wow, I got the best strategy ready. This one confirm win, guarantee chop lah, I chung. Then when markets start to retrace right here, what happened is that you start to panic already. Hey, you suddenly all the things that were working for you no longer works. And when markets start to retrace, right, because you don't even know what you are doing in the first place, you don't know how to hold your profit. So imagine that if you can't hold your profit, right, do you think you can follow your stop loss? Do you think you even have any kind of risk management? Probably not. When markets start to retrace, right, they will try to hold on to their losses lah. They will try to double down some more. And then what happened is, during market retrace, market only dropped by this much. Market only dropped by this much, but their account probably dropped about this much. And after they drop so much already, right, they panic already, they cannot hold their position anymore. They like already hit that despair mode. It's like, wow, lose so much already, all the profit give back already. And then they decide like they exit all their position. They can no longer take the loss. Then when they exit all their position, right, and when markets start to recover again, they have already panic exit everything, and then they are no longer holding any strong counter. They have no concept of which is the strong counter, which is the weak counter or whatever. And then they start to chase the market again when the market start to recover. So which is good. They start to chase the market again. So once again, like whatever they buy, they'll probably get profit. But similarly to before, even though they can profit, right, maybe the moment they profit until they recover back to their initial account level, they are happy already. Even though the market went up by this much, they only profit a little tiny bit, because once again, that mentality is in their head already. Got profit can already lah. Then when the next retracement occur, same thing is going to happen, and their account is going to drop some more, or even worse, it might drop even lower. So even though while the market is going uptrend with higher lows and higher high, right, the traders' portfolio is like the totally opposite. Mainly because when market is in uptrend, they cannot maximize their profit, and when market is in a downtrend, they lose more than what they should have been losing. And a lot of traders cannot get out of this trench. And the reason why they cannot get out of this trench is because they do not have a systematic manner. They don't know how to take care of their portfolio. They go to courses, they go to YouTube, they listen to this strategy, that strategy, but their mindset is they only focus on the strategy. They think that if I can predict correctly, I'm going to win a lot of money. That's all they think about, prediction. And prediction are 100% correct. That's their mentality. But they do not think of the other perspective, where what are the chances that you could be wrong? Okay, you take this trade and you profit, but if you take this trade 100 times, what are the chances of you getting profit if you take this trade like 100 times? And if you keep repeating this over a large number, right, are you sustainable? Is your strategy sustainable? And most of the time, retail trader don't even last 100 trade. Within the first 10-20 trade, they blow their account because of like some funny issue, and then their trading career just end just like that. And why do traders blow their account? Mainly because they are risking so much on their strategy. They feel that their strategy can predict something that is correct, and then they go and risk like 10%, 20% of their account. And then when they start to lose, right, they probably lose like 50-60% one shot of their total entire account. They don't care about the risk because they feel that the correct strategy can sort of ignore the risk lah, since correct strategy means 100% win, that kind of mindset, you know. And these are the kind of mindset that actually kills a lot of traders out there, because they cannot survive. They do not think of long-term sustainability of their trades, of their trade strategy. They just take like two or three trades, and then within that 2 or 3 trades they feel that they are profiting, and then they assume that, okay, this strategy, well, I'm going to use this strategy, and then they start risking everything, and usually they end up in this pattern. Which is why, right, your strategy and your stop loss placement are very, very important. And which is why in our trade strategy and our trading setup, everything, right, we always aim for uptrend counters. We always aim for all the uptrend counters, and you will realize our stop loss are also very, very important. They are placed in a strategic manner. They are placed very nicely, in a sense that they are always below some critical level. They are always below a support. So when markets start to retrace, right, a few things can happen. Some of your counters might hit your stop loss. So if they hit your stop loss, then so be it. You simply exit the trade, mainly because it goes to show that these counters are not strong. If they hit the stop loss, it means that certain levels are being broken, certain crucial levels are being broken. So for example, if I take a trade such as, let me go and find something. Okay, let's say if I take a trade such as AEM, right? Our stop loss was placed below here. This is the critical level. Okay, so when the market retraces, as long as this critical level is not hit, then it goes to show that this counter is a strong counter, because it is not hitting the stop loss. It is not breaking the critical level, meaning I just stick to my trade plan. If you go and panic exit, like don't know what you are doing, then you probably miss the opportunity to get this very big profit. Similarly, right, if let's say the counter go and break the support and hit your stop loss, it goes to show that this counter is not a strong counter. So the support is already broken, then you should be exiting the trade. So everything is very systematic. You just need to follow them. And over the period of many, many years, right, we have learned that a uptrend counter means the previous support is always held, meaning as long as if the price went below the previous support, right, then this is a clear sign that this counter is no longer good. This counter is bearish ready. But as long as that previous support is held, it is not broken, it means that this counter is still strong. Which means to say that just by placing a stop loss below the previous support in an uptrend counter, it is highly likely that most of these counters are going to survive any form of market retracement. All you need is just to hold. And once the retracement finish, once the market start to recover like this, which counter do you think are the one that are going to recover the best, the most? It is those counters that retain their support level. It is those counters that does not hit their stop loss. So these are the counters you will most likely be holding if you follow the trade plan. Whereas those that hit the stop loss are probably out of your portfolio already. So you probably do not want to hold them. And the strategy itself help you discover which are the strong counter, which are the weak counter. And you are not supposed to fight the retracement. You are supposed to make use of the retracement to let you know which are the counter worth keeping and which are the counters you need to let go. And when the market recovers, all I'm holding are strong counters, and they are going to recover as like extremely well during the recovery phase. And what is going to happen is that it's going to be different from this scenario, meaning when market is in a bullish mode, my account will be like this, equally bullish. But when the market goes into retracement mode, I will probably have a few counter hit with stop loss. So maybe my account will retrace something like this. But after this retracement, all I'm holding are strong counters. So what's going to happen when market recover again? My account will recover much better than the S&P 500 because right now, all I'm holding is all the strong counters. All the weak one has been weed out by the market. I have simply like let them go already. So my account is going to recover so much, which is why you see that during retracement, right? I do not panic. I do not suddenly, oh my God, carnage on the street, run, like market crash, Omicron. I never, I don't do any of those stuff. I just look at the index. I look at my portfolio. Is something hit stop loss, then I'll take the loss. If nothing hit stop loss, then I'll be like, meh, okay, like sure, retrace. I don't like suddenly panic, like very hype up and then go and like all these kind of big words suddenly shouting like the sky is falling or what. Guys, please don't do that. Please don't do that. Just relax. We have been through this many times. We have been through this cycle countless times that it is repetitive, and each time market retrace, I'm very happy because it is an opportunity for me to find out which are the weak counters. And guess what? During this retracement, my personal portfolio it's not nothing hits stop loss. Nothing hits stop loss. None of my position hits stop loss. Of course, previously there were quite a number of counters that I was holding hit the stop loss here, but I happily exited them because number one, they are not strong counter anyway. I do not want to be holding. Number two, the cash is free up for me to enter the strong counters such as Nvidia, AEM, Hourglass, whatever lah. Okay, so that retracement allow me to get rid of stupid stuff and then add my cash onto the good stuff. And the market movement is helping me do that. I do not fight the market. So if you are always the kind that like cannot handle just a bit of market movement, you must be always seeing green in your portfolio, or you must be like the perfectionist, always have like 100% profit. You must always catch the top. You must always buy the bottom, right? Then trading is not really for you, I'm sad to say. But if you are those that can really just follow a simple plan, take care of your risk, and just learn to follow a simple plan, then trading is of course definitely for you because as we teach in our course, right, the way we look at trading is in a statistical approach. We look at it in a statistical manner where when we see a strategy works, we don't just deem it that, okay, this strategy works. But what we do is we ask the question, if I perform this strategy 100 times, how many of those times can it work? Because sometimes a strategy can only work like that one time and you are lucky to be profit in that one time. So for example, like if you YOLO your entire account on GameStop and then you got like 20 times your portfolio, right? Yes, it works, but maybe it only works that one time. It cannot be repeated. And if you decide to replicate that success, right, what's going to happen is all your future trades down the road, most likely they are going to be hit with a massive loss because you are now trying to leverage like to the max and you're trying to go for that lucky run, but that lucky run never happens again and you will end up not only giving back your profit that you got in the first place, but you end up losing even more than what you can afford. So these are the kind of thing that, these are the angle that we look at, because there are a lot of factors in the market that is not as simple as like good strategy mean you confirm win, that kind of thing. We have to look at it in a statistical manner. So if you make like 3 trades and that 3 trades is profitable and then you deem yourself that your strategy is the best or this one confirm work already, then that is wrong, because 3 trades is not a statistically significant number. That's why the law of large number is something that we teach, something that we emphasize in our Patreon and in a lot of our course topic also. We must ensure that whatever that we are doing, it can be sustainable. And that is what we teach in our course. So hopefully in this situation, I don't believe that the market is like very strong. It can go on for like the next, it can be very, very bullish. But that doesn't also mean you should panic and start selling everything. Because when the market retrace, the strong counter will never hit their previous support. And if these counter never hit their previous support, they continue to make higher lows, then you should be sticking onto them. You should be holding onto them. You must know how to hold. If you do not know how to hold, or if you cannot even manage like a 2 to 3% retrace, right, then in the long term, you are probably not going to be sustainable as a trader. So at its core, right, strategy is one thing, but your risk management and how you look at trading, how you approach trading, that mindset is also very important. If you do not manage it from the right angle, the statistical angle, right, and you take trading as something that can be 100% predicted, then you are probably not going to have a profitable trading career lah. Okay, so my advice for those who were impacted during this period is that stay calm. Don't use bombastic word to describe the market, because the language that you use can affect your mindset. And most of the time, the news outlet, Bloomberg, or even other influencer or the YouTuber, they like to use these kind of big words to get clickbait or views, or like try to hype up everything. So please don't go and start using things like blood on the street, that kind of words. Just remain calm, okay? 2 to 3% drop should not scare you. If a 2 to 3% drop scares you, then you are probably risking more than you should. But as subscriber of my Patreon, I have always advised that you should not risk more than 3% of your portfolio per trade. Meaning to say that if you can have 10 open trades with your capital, and all that 10 trades are hit with a stop loss, at maximum, you are going to lose 30% of your portfolio, because 3% times 10 is 30%. And that is your drawdown. And 30% drawdown is actually quite okay. It's manageable. You can recover from a 30% drop. But if you are on some CFD account, and then you are risking like 10% of your entire portfolio per trade, and you have like 15 trade opens, not only you will lose like negative 150% from your account, right? You might end up owing the brokerage money also more than what you actually have. So these are the kind of things that traders get themselves into without really realizing it. So please take care of your risk. If you take care of your risk, right, the discipline will come naturally, because you are dealing with numbers that you can manage. If you look at my personal portfolio, I have 150K account. My current portfolio value is somewhere around like close to 200K. But the maximum loss that I have taken is only 5K, which is not even 3% of my portfolio. But if you are out there with a 10K account and you are taking like 2K, 3K loss, right? Then that's definitely something to do with your risk management issue already. So there are always strategy, risk management, and your mindset, your mentality, how you handle trading. These three are equally important when it comes to being a profitable trader. And most of the time, when traders lose money, right, they only blame the strategy. They don't blame their risk management. They don't blame their mindset. And they start to blame the strategy. They look for a new strategy, and then they keep failing over and over and over. And you can see there are many traders out there over 9 or 10 years in the market, but still cannot be profitable. It is because they are not in the right mindset. They do not have the correct approach to trading. So hopefully this ranting session kind of like, I don't know, put you back on the right track, put you back on the right mindset. Go and look at your risk management a bit, and then try to do a bit of reflection lah. So one of the current position that we hit TP is AEM. And I mentioned that if you are someone who managed to get the AEM trade, but somewhere along the way you did not follow the trade plan, or you prematurely exited, or you even take your profit early, it's time to ask yourself why. Why did you do that? Why did you make that action? Why did you take that action? And is it because you feel market is weak? Okay, if you feel market is weak, then why do you follow this trade? Why do you not follow the stop loss? Because the stop loss is there for a reason. It is there to follow. And if you did not follow that, what caused you to not follow that? What triggers you to go and exit the situation? So these are the things that you should like do some self-reflection and ask yourself, because if you cannot follow a simple trade plan that is given to you based on a specific risk limit, right? Then it is hard for you to like be profitable, because even with a discipline and a plan that is given on a silver platter, you can't follow it. Then it goes to show that like you can't really follow anything, and most of the time you will be facing with a lot of issues, which to you might think that it is luck, or unlucky lah, why I enter this again, why I enter, like every time the counter I enter always red. You will always be blaming all these kind of third factor, and you won't really look at it in your inner self lah, to think that maybe if I follow, I might be profitable. So that's the mindset lah. That's the mindset that traders should adopt, and it is good to do some reflection. Okay, so that's the end of my rant. Just stay calm, and stick to the plan, stick to the risk management, and stick to the plan.